The European Central Bank is trapped. If they raise interest rates to fight inflation, they crash Italian and Spanish bond markets and trigger a sovereign debt crisis. If they cut rates or hold them steady, inflation stays elevated and German savers get destroyed. There is no third option, and the pressure is building toward a break that will reshape European monetary policy and validate gold as the only neutral reserve asset that works across collapsing currency blocks. If you want to understand the European monetary crisis before it goes critical, subscribe now and see the fracture lines clearly. Let's establish the structural problem that makes the European Central Bank's position impossible. The Eurozone is not a unified economy. It's 20 different countries with vastly different fiscal positions, productivity levels, debt burdens, and political cultures, all sharing a single currency and a single monetary policy. That worked fine when interest rates were at zero and the ECB was buying everyone's bonds through quantitative easing. It breaks catastrophically when rates need to rise. Here's why. Germany has relatively low debt to GDP, around 66%, high productivity, strong exports, and a culture of fiscal conservatism. They can handle 4 to 5% interest rates without serious strain. In fact, many Germans want higher rates because they're savers, and they've been punished by zero rates for 15 years. Italy has debt to GDP over 140%, low productivity growth, massive unfunded pension liabilities, and chronic political instability. At 4% interest rates on their debt, Italy's annual interest payments exceed $100 billion, nearly 20% of total government revenue. That's not sustainable. That's a sovereign debt crisis waiting to happen. Spain is at 115% debt to GDP. France just crossed 110%, and Moody's is warning about potential downgrades. Greece is still at 170% debt to GDP, despite the bailouts and restructuring of the 2010s. Portugal is at 120%. These countries literally cannot afford the interest rates that Germany needs to control inflation, but they all share the same currency, so they all get the same monetary policy from the ECB. One size fits none. Here's the mechanism that's breaking under the surface. When the ECB raises interest rates, sovereign bond yields across Europe rise. German 10-year yields are currently around 2.6%, manageable for them. Italian 10-year yields are at 4.1%, dangerous for them. The spread between German and Italian yields, a key indicator of Eurozone stress, is at 150 basis points and widening. That might not sound like much, but here's what it means in practice. Every time that spread widens by 50 basis points, Italian borrowing costs rise by billions of euros annually. At some point, and we're approaching it, Italian yields rise high enough that the market starts pricing in genuine default risk. Once default risk is priced in, yields spike further in a self-reinforcing panic. Bondholders sell, yields rise, borrowing costs increase, deficit grows, more selling, higher yields. It's a death spiral. We saw this exact dynamic in 2011-2012 during the European sovereign debt crisis. Italian and Spanish yields spiked to 6 to 7%. The Eurozone was on the verge of collapse. Mario Draghi, then ECB president, gave his famous "whatever it takes" speech, promising unlimited bond buying to save the euro. It worked. Yields fell. The crisis was contained. But the solution was more debt, more ECB balance sheet expansion, more kicking the can down the road. Now, 14 years later, the debt levels are higher, the ECB's balance sheet is more bloated, and the same crisis is forming again. Except this time, the ECB can't do whatever it takes without reigniting inflation that's already running above target. They're trapped. Now layer in the political dimension, because this is where the Eurozone structure becomes existentially fragile. Germany and Northern European countries are demanding that the ECB maintain higher rates to fight inflation. German inflation is still running at 3.5%, well above the ECB's 2% target. German voters are furious about eroding purchasing power. The German Bundesbank, historically the most hawkish central bank in Europe, is pressuring the ECB to stay tight. Meanwhile, Italy, Spain, France, and Southern Europe are screaming for rate cuts. Italian Prime Minister Giorgia Meloni has publicly stated that ECB policy is strangling Southern European economies. French President Emmanuel Macron is facing domestic political crisis, partly because high borrowing costs are limiting fiscal space. Spain's socialist government needs cheap financing to fund social programs. These are not abstract economic disagreements. These are fundamental conflicts about who bears the cost of monetary policy, and the Eurozone has no mechanism to resolve this conflict democratically. The ECB is technically independent. It's not accountable to voters in any single country. It's supposed to make policy for the Eurozone as a whole, but the Eurozone as a whole is a fiction. It's 20 different economies with competing interests. When those interests aligned during the expansion years during the QE era, the system worked. When those interests diverge, like right now, the system breaks. Let's go back to the 1990s and understand why the euro was always structurally flawed. The euro was launched in 1999 as a political project designed to bind European countries together so tightly that war would become impossible. The economic logic was that a common currency would increase trade, reduce transaction costs, and create prosperity. But there was always a fatal flaw: monetary union without fiscal union. When you have a single currency, you need a single fiscal policy to make it work. The United States works as a monetary union because we have a federal government that can transfer resources from rich states to poor states. When California has a recession, federal unemployment benefits, Medicare, Social Security, all these programs transfer money from wealthier states to California automatically. The Eurozone has no equivalent mechanism. When Italy has a recession, there's no automatic fiscal transfer from Germany to Italy. Instead, Italy is expected to fix its own problems while constrained by Eurozone rules that limit deficits to 3% of GDP. But those rules are impossible to follow during recessions, so everyone breaks them, and then the rules become meaningless. The Eurozone is a monetary union without fiscal union, which creates permanent instability. The founders knew this. They hoped that monetary union would eventually force political integration and fiscal union. It hasn't happened. If anything, the crises of 2011, 2012, and 2020 have made Northern and Southern Europe more resentful of each other, not more unified. And now we're heading into another crisis with the same structural flaw unresolved. Here's the irreversible dynamic now in motion. The ECB has 3 options, and all of them are bad. Option 1. Keep rates high to fight inflation. This is what Germany wants. It's what orthodox monetary policy says you should do when inflation is above target. But it crashes Southern European bond markets, triggers sovereign debt crises, potentially breaks up the Eurozone. If Italy defaults or leaves the euro, the entire European project collapses. Banks fail. Trade contracts break. Political chaos ensues. Option 2. Cut rates to support Southern Europe. This is what Italy, Spain, and France want. It reduces borrowing costs, prevents debt spirals, keeps the Eurozone together. But it lets inflation run higher for longer, destroys German and Northern European savers, and ultimately destroys the euro's purchasing power. If the euro becomes a soft currency that's constantly debased to bail out Southern Europe, Germany might eventually leave. Option 3. Try to thread the needle with targeted interventions. Keep rates moderately high while selectively buying Italian and Spanish bonds to cap their yields. This is probably what they'll try. It's the muddle-through option, but it requires the ECB to massively expand its balance sheet again, which reignites inflation, and it requires political acceptance of the ECB picking winners and losers, which Northern Europe increasingly resents. All 3 options lead to the same place eventually: loss of confidence in the euro as a stable store of value. Whether through inflation, option 2, breakup risk, option 1, or balance sheet bloat, option 3, the euro's credibility is being destroyed. So what does this mean for you as an investor or saver? If you hold euros or euro-denominated assets, you're exposed to a currency block and structural crisis with no good resolution path. The best-case scenario is that the ECB muddles through with targeted interventions, high inflation persists, and your purchasing power erodes 3 to 4% per year for the next decade. The worst-case scenario is Eurozone breakup, sovereign defaults, bank failures, and your assets caught in the crossfire of redenomination risk. Neither scenario is good for euro holders. If you hold European sovereign bonds, German bunds, Italian BTPs, French OATs, you're making very different bets. German bunds might be safe in nominal terms, but will underperform inflation. Italian BTPs offer higher yields but carry genuine default risk if the ECB can't or won't support them. French debt is somewhere in between but trending toward the Italian side as France's fiscal position deteriorates. If you hold European stocks, you're betting that corporate earnings can withstand either high interest rates that slow growth or high inflation that compresses margins, or currency instability that disrupts trade. None of those are bullish scenarios. The smart move for European investors, and this is exactly what wealthy Europeans are doing, is diversifying out of euro exposure entirely. Into what? Swiss francs, safe haven, fiscally sound, not part of Eurozone. Norwegian kroner, backed by oil wealth, strong current account. Gold and silver, neutral assets that don't care about ECB policy or Eurozone politics. U.S. assets, despite dollar problems, still more stable than Eurozone. Real estate and businesses in non-European jurisdictions. Anything that reduces exposure to the euro crisis. Let's talk about what institutions are doing in response to ECB policy stress. European pension funds are quietly reducing home country bond exposure and diversifying internationally. A German pension fund that was 60% German bonds 10 years ago might now be 40% bonds, 20% global bonds, 20% equities, 10% alternatives, 10% gold and commodities. They're not making dramatic announcements. They're just slowly, persistently reducing euro concentration. European insurance companies are doing the same. They have to hold some domestic bonds for regulatory reasons, but they're minimizing it and diversifying everything else. Wealthy European families are moving capital to Switzerland, Singapore, London, despite Brexit, and the United States. Not to evade taxes, most of this is legal and reported, but to diversify political and currency risk. They remember what happened in Cyprus in 2013 when bank deposits were confiscated to bail out the banking system. They remember capital controls in Greece. They remember the fear during 2011-2012 that the euro might actually break up. They're not waiting for the next crisis to move. They're moving now while capital is still freely mobile. Even some central banks within the Eurozone are diversifying reserves. They can't publicly reduce euro holdings without causing a crisis, but they can increase gold holdings, which several have been doing. The message is clear. The institutions with the most exposure to the Eurozone are the ones most aggressively diversifying away from it. Here's the moment of absolute clarity about what the ECB crisis means for the global monetary system. The euro was supposed to be the alternative to the dollar, a large, liquid, stable currency backed by advanced economies with the rule of law. If the dollar ever failed, the euro was supposed to be the backup. But the euro is failing simultaneously with the dollar, just for different reasons. The dollar is failing because the U.S. has unsustainable debt and is weaponizing currency for geopolitical purposes. The euro is failing because it's a currency union without fiscal union, which makes coherent monetary policy impossible. Both are failing because they're fiat currencies managed by institutions with conflicting mandates and political constraints. And this is the critical insight that most investors miss. There is no fiat currency alternative that works. You can't escape dollar problems by moving to euros. The euro has its own structural problems. You can't escape to yen. Japan is even more indebted than the US and has been printing money for 30 years. You can't escape to yuan. China has capital controls, property bubbles, and demographic collapse. Every major fiat currency is in crisis simultaneously because they're all based on the same broken model. Unlimited money printing to fund government spending that voters demand but won't pay for through taxes. The only assets that escape this dynamic are the ones that can't be printed. Gold, silver, Bitcoin, for those who trust it, real estate in stable jurisdictions, productive businesses, anything with intrinsic value or scarcity that doesn't depend on government promises. The ECB's impossible choice is just the European version of a global problem. Here's your action plan if you have European exposure. Step 1. Assess your euro concentration. If you're European and 80-90% of your wealth is in euro-denominated assets, that's dangerous concentration risk. Not because the euro will collapse tomorrow, but because you have no diversification against a slow erosion scenario. Step 2. Diversify currency exposure. Target 40-50% euros, 20% Swiss francs or Norwegian kroner, 20% dollars, despite their problems, 10-20% gold and silver. This isn't market timing. This is risk management. Step 3. Reduce exposure to weak sovereign debt. If you own Italian, Spanish, or Greek bonds, understand that you're taking credit risk in a system where bailouts are politically contentious. German and Dutch bonds are safer but offer terrible real returns after inflation. Consider replacing European sovereign debt with corporate bonds from strong companies, short-duration instruments, or alternatives. Step 4. Increase hard asset allocation. Physical gold and silver held outside the Eurozone banking system. Real estate in politically stable countries with property rights, Switzerland, Norway, US, Canada, Australia. businesses with international revenue streams that aren't dependent on European growth. Step 5. Plan for optionality. If you can legally hold accounts in multiple currencies, do it. If you can store some wealth outside the Eurozone, do it. Not to evade anything, just to have options if capital controls, bank bail-ins, or currency redenominations happen. The European Central Bank is trapped between fighting inflation and preventing sovereign defaults. They cannot do both. Germany wants high rates, Italy needs low rates, France is stuck in the middle. The Eurozone was built on the idea that monetary union would force political union. It hasn't. Instead, it's created a system where 20 different countries with 20 different fiscal positions share one monetary policy that works for none of them. That system is breaking, not tomorrow, not in a single dramatic crisis, but slowly, persistently through widening bond spreads, through inflation that won't come down, through political resentment between North and South. And when it breaks, when Italian yields spike to unsustainable levels, or when Germany decides it's done subsidizing Southern Europe, the people holding euros will discover that their stable currency was built on an impossible political compromise. The people holding gold will discover that neutral money that doesn't depend on political compromises was the right hedge all along. The ECB's impossible choice is Europe's problem today, but it's a preview of every central bank's problem tomorrow, because when you promise infinite benefits funded by infinite money printing, eventually you run out of other people's willingness to hold your currency. And when that happens, the repricing is brutal and sudden. The euro's crisis is just beginning. The question is whether you'll be positioned for it or whether you'll be asking what happened when your purchasing power is gone and your options have evaporated. Choose wisely.